What a wild week it's been. We were down and then we were up, and it's I get a fake out and you get a fake out. Everybody gets a fake out. At this point, I think it's pretty fair to say that having trust issues with this market is very reasonable. So let's have an objective look at the data points without saying anybody should be embarrassed, bulls or bears, and see what's on tap for the coming week's worth of trade. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not done so already, and stay tuned until the very end of today's video. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame, now that April has officially closed out, for structure, we're certainly dealing with a hammer candle. So buyers, of course, stepped up in the lower wick, went to the opening print, through the opening print for a solid green-bodied bar, and of course, we do have a close at the highs of the monthly range. So that does strike me as being bullish. Of course, the range is very compressed. We were basically stuck in a range. We'll see that on the weekly for all of the month of April. However, we have closed above a key pivot point here on the monthly time frame chart. You can see what was once acting as support, then acted as resistance, 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 and we have closed above that as of the monthly bar. So it brings into question, is this the beginning of a monthly inverted head and shoulders breakout? It certainly could be, but I would want to see more of a definitive close above the level, or even just a higher low test and then continuation on the monthly time frame chart. There is a considerable amount of room to run overhead to our next monthly time frame target. Again, we're not making the call that we're going here this week. We're just talking about higher time frame structure. 455 coming from this previous set of tops over here does look interesting on the monthly time frame. I also want to remind you on the higher time frame that if we take out the fibs from the sickness low to high, we're still above the 38.2. So larger bearish calls at this point in time in the context of this overall move. I know it's been a brutal year through 2022, but in the context of the overall move, it doesn't make sense that the market is really in jeopardy of something larger unfolding to the downside. You can see that the 38.2 has acted as support over the past couple of months as we've been building out the right shoulder of the inverted head and shoulders that we were just referring to. If we come in from the all-time high to the most recent pivot low from October, what you'll also notice is that we're inching up on that 50% retracement. So again, it's fairly difficult to say that even this is turning into a bear flag. Ideally for bear flag, you remain underneath the 38.2. Let's go ahead and drop it on down to a weekly time frame chart now and see what's going on from this perspective. So once again, structure and location definitely strikes me as more bullish than bearish. We do have a hammer candle here. The long lower wick represents buyers stepping up to the opening print, through the opening print, because we have a green bodied bar, closing at the highs identical to the monthly time frame. Now, location here is different, of course, because we did make a lower low, but also an equal high on the bar to bar count. Now, many people will look at this and say, it is a bearish pattern. This is a hanging man, Matt. This thing has to go to hell in a handbasket. And I would say not so fast. I mean, I totally understand that, yes, the lower wick does imply that there is now a change in tone with some selling pressure, but think about what the close of this bar represents. The sellers took it underneath the previous weekly low, that consolidation low. Remember, we were basically unchanged. There's no follow through underneath that low, and where do we close? Back at the prior week's high. So I'm not really looking at this bar individually as bearish context, of course. So what else is going on here? I mean, it goes without saying that we're at the top of what can start to be considered an ascending triangle, something that would look right along the lines like this. And this certainly could start to act as a higher low from a trend perspective. If we're going lows, higher lows, higher lows, this pullback, although it didn't result in a red-bodied bar on the weekly, it could start to be construed as the higher low set. If we start to break out here, I would think of it in that manner. The other thing that's really special about the low of this hammer candle is that as nasty as it seemed on the Tuesday and Wednesday breakdown, where did we respect? Right to the top of the banking crisis candle high. So overall, not that much damage was done as the breakout started to unfold, and especially with the close at the highs, I'm just not seeing the stronger case for bears at this point to step in and send this market lower down towards these lows even. Remember that we were saying if this is going to turn into a double top, that's fine, but for it to truly count as a double top reversal, we need the lower lows, and with this weekly bar in play, doesn't really seem like a high probability that we're coming down here anytime soon. So let's go ahead and zoom out a little bit, and I just want to remind you of a couple of other things. If we throw on the anchored VWAPs from the all-time high and the October low, we're continuing to push away from this in the upward direction. Once again, this lower wick found support at the top top of the anchored VWAP band. If we take a look at something like our volume profile on the weekly time frame chart, what we'll also notice is that there were two high volume nodes that could have been in play as the breakdown was trying to resolve, right? So we pull back off of the overhead high volume node and we find ourselves on that Tuesday breakdown in the low volume void. We know that the market should be drawn to a high volume node. And which node did it choose? It chose the upper high volume node instead of finding this gravity point down here closer to 390 in the SPY. Once again, a very minor but subtle bullish data point that continues to stack up. I would just remind you once again that the trend here is up in the short term, but things will become much more clear on the weekly time frame chart when and if we can definitively push out of this box, which based on the previous week's action looks like it could be as soon as the coming week's worth of trade. But let's take a look at some supporting evidence. On the daily time frame chart, let's first evaluate the weekly expected move. If you're not familiar with this study, top right-hand corner's got you covered with a brief tutorial. Overall, if we're contained by the upper bound of the expected move here, the number is 423.19, and that, of course, would suggest a higher high being produced above this pivot, as well as the weekly pivot here at 416.75. Definitely a more definitive break of that monthly inverted head and shoulders neckline that we were just looking at. That does strike me as being more bullish than bearish. If we're contained by the lower edge of the weekly expected move, the number is 408.75, and that of course implies a higher low above the Wednesday breakdown low, but even more important than that, it's a higher low inside of, not at the lower bound, not underneath the lower bound, inside of, above the lower bound of the original balance area. So overall expected move here does strike me as being more bullish than bearish. From a trend perspective, I don't think it's fair yet to call this a new uptrend, considering that from here to here, we do have a lower low and we're only sitting at an equal high. So I think that currently the trend would be classified as neutral, and to of course confirm a new uptrend, we are looking for continuation to produce a higher high or some sort of higher low confirmation to then look for continuation in the upward direction. So noting that a higher low pullback is required, or one of the requirements for a new uptrend to form, where would ideally we pull back to? It would be right to this zone right around in here, and we do want to treat it as a zone. Of course, we do have trust issues with this market, so anything that's above 411.50 or 410.35 does strike me as the ideal picture perfect place for a higher low to form, and then a retest here should look for continuation in the upward direction. If we go further than that, the line in the sand literally is the lower edge of the weekly expected move, because it coincides almost perfectly with the single prints from the breakdown on Tuesday's session. We'll get more granular and look at that on the hourly in just a moment. So line in the sand is literally the lower edge of the weekly expected move, but in a picture perfect world, the higher low is above 410.35. If we do see continuation in the upward direction, a break of this pivot at 416.75 is bullish. You could look to go with it on an equal high breakout, but again, with trust issues in this current market environment, I think the more respectable trade would be looking for a break, retest for a higher low above the top of the range, and then we can look for continuation in the upward direction when we've clearly shown that the market does want to turn prior resistance into new potentially support on the retest above 416.75. So I'd be very cautious about chasing continuation here at the highs, especially considering that from a pattern perspective, right? If this was going to be construed as a look below and fail, we're home. We've hit the target. We're at the upper bound of the range. That's exactly what we look for on a look below and fail. So a pullback could be, and probably should be, based on some other evidence that we'll look at in just a moment, the primary objective early in the week, and then some sort of continuation in the upward direction if we're looking at this objectively, trying to achieve a new daily uptrend. Let's get a little bit more granular and take a look at the hourly time frame chart. There's a couple of things that I want to talk about here. Number one would be that the bears certainly had momentum on the Tuesday and Wednesday session. It was a respectable breakdown underneath this flush point here at 410.35. The issue is that we have seen a 100% retracement of the move and some in the upward direction. So unfortunately, that bearish momentum, it's not really alive and well in the market at this point in time. I think on the Wednesday close, it was very reasonable that we were looking for lower highs under 406.15 to then target 401. Okay, if it wants to go a little bit further than that, we'll give it some wiggle room to the single prints here, lower high underneath 408.50, then we'll retarget 401. Obviously, you can see there's no attempt at a lower high here. There's no attempt at a lower high here. There's not even a lower high attempt at the retest of the breakdown point at 410.35. So with the lack of these attempts for the market to try to push lower in the downward direction, I think the most respectable thing to do is look at this and say, okay, we know that we're in an indecisive market. If this is truly going to flip into an uptrend on the daily time frame chart, as we just said, this is probably the primary outcome that we want to be looking for. Another thing that I would point out is look at the Friday morning pullback. Here it is. It's the lower wick of that red bar. Where do we find a higher low intraday on the Friday session? Well above 411.50, which, as we know, represents the original balance area from way back here. That does strike me as a bullish data point, the fact that the bears were unable on this pullback to push prices down underneath that area, and instead the buyers responded with some strength into the close. Another thing to point out is if we take out the Fibonacci's on this hourly time frame chart from the beginning of the breakout, not the low of the breakdown, but the beginning of the breakout, all the way on up to the high, remember always that a 61.8 fib is the line in the sand. As we start closing bars on any time frame underneath, the odds dramatically increase to start to look for that 100% retracement. So as we were pointing out on the daily time frame chart, notice that the 61.8 is right at your 410.35, right? So a little bit of confluence of support around this area. The 38.2 is right at the low of the pullback we were just discussing from the Friday morning session. The 50% retracement, right? You can see that there's a number of things providing confluence of support. Once again, building the thesis, so to speak, that a higher low pullback here should be respected after this bullish momentum, after the bears didn't really capitalize on the opportunity for that lower high underneath 406. Let's take a look at some more supporting evidence, because I don't think it's quite so clear cut that the bulls are just going to run away with this into all-time highs. Market internals are always Exhibit A. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. Let's take these charts one by one. Top left is our volume reads. Outflows significant on the Tuesday breakdown, followed up with some decent reads on Wednesday. Inflows significant on the rebound from Thursday, followed up with some decent reads on Friday, and we neutralize the net weekly cumulative flows. So I would say that this is kind of a moot point for our market. In the advanced decline line, notice that on Tuesday, the breakdown is more substantial than the recovery effort on the Thursday session. And I'm not trying to justify this move as being the strongest thing in the world, but just ask yourself the question, psychologically, is it easier for participants to panic out of downside moves or buy into new uptrends? And you can reasonably draw the conclusion that more often than not, the downside reads will always be more significant than the upside reads. The main point here is to just note that the advanced decliner on the rebound day was not negative on the day, and it did make an attempt to get into the trend higher zone up here. Certainly on Friday, this move is more powerful than this on the Wednesday follow-up to the breakdown. In terms of the cumulative reads on the tick, I would say the same thing about is it easier to panic sell or buy into a new uptrend? So these things kind of neutralize each other. I would certainly be concerned about the very mild read on the Friday session, as we did see follow through in the upward direction. So once again, reasonable for a pullback at the top of the range we just saw on the SPY daily? I certainly think so. I do want to point out to you though, however, before we move on, there were two different types of buyers who participated on the Thursday session, and we can specifically see this in the tick as well. So in the tick, as we open up here, notice as these extreme reads are taking place, this is short covering. Look at the size of these candle bodies in here versus all of the candle bodies that were happening in here and into the close over here. More extreme, more emotion in the opening session, and this is much more indicative of short squeeze, right? That's why this is really sitting and hovering over the zero line on that Thursday morning session. And as we move into the later stages of the day, this strikes me as being much more algorithmic type buying. I'm not saying new money buyers are just pedal to the metal looking for full steam ahead, but certainly this is not just short squeeze that was taking place on the Thursday rebound day. So I would not chalk this move up to saying, hey, paper-handed shorts are closing out and that's all that's going on in the market. No, this right here is certainly worth respecting, and we can see that it's more algorithmic than just emotionally driven. Market profile is always Exhibit B, video tutorial in the top right-hand corner if you're not familiar with this screen either. Let's keep it very simple here. Overall, the value area on the Thursday session did what? It was breakaway to the upside as compared to Wednesday, and the same thing holds true on the Friday recovery effort as well. You'll also notice that the point of control closed high in the profile on Thursday, as it did as well here on the Friday session. We did have a poor high on the Thursday session. That, of course, is repaired based on Friday's activity. And there's one small nuance that I want to point out to you here on the market profile. We, of course, did see some pretty thin structure on the Thursday breakout that was taking place. You can see that the profile is fairly sparse, but you'll notice that we have a string of single prints right here. And the lower bound of those single prints also coincide with this as an overnight low. And lo and behold, if you were to compare this to your SPY chart, this is the equivalent of 410.35. So this is also reinforcing the idea that if the market does pull back, the key zone that you want to look for on the SPY would be 410.35. On your ES futures, you're looking at 41.32 as being a key area of support. If you find that the market pulls back, finds support here and starts rallying in the upward direction, that was an ideal higher low pullback. I would start to think about daily uptrends. Jumping back on over to Thinkorswim to evaluate the weekly performance of our sectors reveals that at the top of the pack is the XLC, really outperforming there based on the meta gap up from earnings, up 3.79% on the week, followed by the XLK tech sector. Both of these were up just about 2.5% or better. After that, we see real estate and then consumer staples. Those were under 2%, under 1.5% performance on the week. You can just see that here. So posture does strike me as being noteworthy as this reversal has been underway in the S&P markets, right? We're not being led by the defensive sectors. At the bottom of the barrel, we see the defensive sectors. We see the XLU, utilities, XLV, healthcare, industrials, materials is lightweight, and financial, sure, it's red, but it's only down 0.08% on the week. Let's check in on the structural charts. Posture-wise, things are not that bad if we look at the ranking of our sectors here. So XLC, communications, completely reversing from this, obviously on the meta earnings gap up. So all things considered, this chart is back in the bull camp. Now, I would say it's not ideal to be chasing this for higher highs after this big significant reversal on a gap higher. I would be thinking about pullbacks for a higher low and then a reattempt of 60, then a break to 61. That's much more constructive, obviously, but it is back on the bull side of the market. So pretty tough to say anything bearish about communications at this point. Even on a pullback, structurally, it is healthy. Same thing could be said about the XLK. I mean, look at this big major breakdown on the Tuesday session. Found support at the daily 50 SMA, also off of the top of the balance range from back here. Support previously over here as well. Not only did we not find a lower high off the retest of the bottom of balance, which was looking likely with the inverted hammer from the Wednesday session, we went into the balance and, of course, look below and fail has panned out. We're right back up at the top of the range. Once again, based on the activity here and how we've arrived at this location, do you want to be chasing, longs here? Probably not. In a picture perfect world, it's a higher low over 149.15 to keep us bullish and constructive. Then on a reattempt, we look for follow through. If we do just break in the upward direction over 151.50, again, I wouldn't chase it here, but I would look for a higher low above on a break and retest, and then start to look at 155.80. Quite a ways to run overhead if this does want to continue in the upward direction. XLRE for real estate, it's not really doing anything all that impressive. Here's a balance range. It's trying to make it out of it in the upward direction. Really lightweight sector, has much more to do with the wealth effect, but it is a positive force for the S&P 500 nonetheless. XLP is a slight cause for concern, especially noting if the XLK pulls back this week aggressively and the XLP continues here over 77.50, that would be a little bit of a red flag posture-wise, but unless that XLK actually does pull back, it's not there yet. It's something to keep on your radar, the relationship between the two, but so far so good with the recovery effort out of the XLK specifically. Anyways, when evaluating this chart on its own, we've already rejected for a pullback here, and now we're reattempting. This is the equal high breakout that you would be looking for over 77.50, so watch for that to unfold, and it looks like we're moving into fairly uncharted territories. We do have a previous high from back here. 78.25 would be the next watch. Next up, XLE, playing nicely. No concerns about energy, just back in the balance range here. Maybe a look below and fail. If we do make it to the top end of the range, we'll look for rejections at 87.50, but no red flags, no concerns. It's lagging beautifully in this current environment. XLY, you dirty dog, back at 148. You guys know I have an issue with 148. Is finally this going to be the time? I don't know any better than the next guy, but if we look at what's going on here, yes, we are still producing higher lows. Although this was the previous set of higher lows, this kind of looked nasty. Again, the reversal and recapture from the Thursday and Friday session does strike me as being noteworthy. So we'll watch 148. We'll continue to watch that really pesky level. If it breaks here, that's extremely helpful for your S&P 500, seeing continuation in the upward direction out of a heavier weight risk-on sector. Utilities, very similar to energy as of right now, just playing nicely in the balance area here. No red flags. Continue to play nice, and we're all fine and dandy in the S&Ps, right? Let's take a look at the XLV healthcare sector here. It is the second heaviest weighted sector by market cap, but as we know, it is D for defensive in terms of posture. So we don't want it falling off of a cliff because it is such a heavy weighted representation in the S&P, but we also don't want it leading any rallies in the upward direction. Is it doing either of those two things? Absolutely not. I would say that this also is playing fantastically nicely with its other, constituents, other sectors here, and doing exactly as it should. It's not falling off of a cliff, and it's also not leading the breakout up and over these highs. I would say as long as this plays nicely in the box here, kudos, no red flags, good to go. Let's take a look at the XLI for industrials. It's in the midpoint of its range, roughly 8% of our S&P 500. One thing I will note about the XLI is, of course, in the Wednesday video, we said, hey, probably not a new short, dead on the lows of the balance range, daily 200 SMA here, but the concern would have been a lower high underneath 98.70. Obviously on the Friday close, not the case. We did not produce the lower high there. We can still produce a lower high, right? This is equal highs, still a lower high opportunity at $100.15, but what you'll note is that this is much more centered in the overall range as opposed to in the lower third. So that does strike me as being slightly more constructive in the upward direction, or at least neutral. Next up, XLB materials sector. This is a really, really lightweight sector, not all that influential for the S&P, but look below and fail, again, playing nicely, even if it comes up in here. It's bullish pressure for the market. We're not really concerned about leadership in the XLB materials, so we're moving on to financials. What's going on with the financial sector? Pretty powerful reversal as well. Remember that we were concerned as we were sitting on 32.25 that, hey, if this doesn't hold here, massive red flag for the S&P marketplace if we break down. Obviously, it held, and then just like the XLI, the concern was that there's an opportunity for a strong lower high underneath 32.85 with the Friday close poking above that. Don't get me wrong, there's still a lower high opportunity somewhere in here, but the fact that we've recaptured the gap up level from the JP Morgan earnings announcement, right, does strike me as considerably constructive in the upward direction. Sure, we might reject the daily 50 SMA. Sure, we might just chop around in here. But the fact that we didn't just straight up get rejected for a lower high and then a breakdown like this does strike me as a bullish look for our S&P. Here's the sector ratio grid. If you're not familiar with how to set this one up, top right-hand corner's got you covered with a brief tutorial. Overall, the top four are the heavyweight sectors for the S&P 500. Loving the rebound out of the XLK off of the daily 50 SMA, the gold line here on the charts. But unfortunately, it's the only thing that's really powerful for the risk-on look. Obviously, XLV is going sideways now. Financials trying to perk up, but really still depressed underneath that daily 50 SMA. And the XLY, without that breakout of 148, it's going to be really tough for this to flip into a more meaningful move over the daily 50 SMA. The closest tie to something looking good like the XLK is the XLC here. Communications with the Meta earnings obviously perking this thing right up in the upward direction there. The bottom four are the lightweight risk off sectors. We can definitively call these risk off. Staples is coming back down. So this little perk, this little threat is like, maybe not right now, right? We're coming back down to earth here. So certainly not a full-blown risk off look. Same thing with utilities as well as energy being underneath that 50 SMA now as well. Let's take a look at the XLY over the XLP for growth versus value, and of course we're still grinding in the lower direction. It's all going to boil down to that 148 level in the XLY. Is it going to break out? Again, I don't know any better than the next guy, but if it does, I have to imagine that this ratio perks up, and then that starts to look more constructive for a risk-on type look. Checking in on the dollar, even with the funky price action, what you'll note is that prices remain underneath 102 in the dollar, which in theory does build the bull case for equities down below. But the question becomes, to this degree on the Thursday and Friday session, probably not. You would have expected a stronger breakdown out of the dollar to pair with this rally out of equities. It simply wasn't the case, so watch out for that to become a little bit of a divergence if we see, for example, the dollar recapture 102 and equities remain high. Probably a bit of a red flag and something you can watch out for early in the week. Unfortunately, our good friend gold isn't really telling us a whole lot about any further implications for the dollar, really just pegged sideways here at the $2,000 mark. We'll learn something when and if we push here or here away from this area in a more substantial fashion. If we take a look at something like the TNX for our 10-year rates, we are now dealing with this as a balance range. And one thing I just want to remind you of is that stable rates are often more bullish for the market, right? As you're really whipping around and getting rate volatility like what we saw in here, it's much more difficult to trade that type of activity. And although this balance has been painful, this certainly does start to look more constructive for reasonable moves unfolding in the market. Ideally with the implication that the Fed will be cutting rates in the back half of 2023. We're coming up on one and done in terms of one more hike and then a pause, right? You would imagine that there's probably more incentive for this to break in the downward direction as the TLT and bonds start to get more attractive over their breakout point. We'll look at those momentarily, but this, in theory, would be more bullish for your XLK, which is already starting to exhibit some leadership. One thing I would point out is that we never actually broke the top of this range here in rates, right? This was looking like the beginning beginnings of a bull flag pullback in here. A breakout over 3640 would have been concerning for the XLK. Obviously, it never happened with this gap down, and now we remain sort of underneath the midpoint of this range in here that is bullish for the equities market down below. Let's take a look at the tracker tool. We continue to see higher odds of a 25 basis point rate hike for the next meeting, which, by the way, is this upcoming Wednesday at 2 p.m. Do expect some volatility around that time frame, but a 25 basis point rate hike, as well as, if we go out to the probabilities tab here, the higher for longer narrative is back on the table with the first cut coming in the month of November. Recall that as the cuts were starting to be priced in sooner and sooner and sooner, that's much more of an issue and a suggestion of a hard landing from the Fed having to cut rates because something has broken. The further out this can stay, the better for achieving a soft landing and naturally reducing rates because inflation is coming down and their objectives are being met. Speaking of inflation, we got the PCE report on the Friday session, and annualized, this monthly read really isn't all that bad, a 0.1 on the PCE reading. And what you'll notice here is that energy services really came in aggressively, down 3.7% on a month-over-month basis. That's pretty strong. We know that the sticky inflation really remains in the housing services industry, so continue to watch those economic numbers. When those start to come in, I do imagine that the Fed, responds favorably to that data. If we look at the Thinkorswim interpretation of the year-over-year, this is core PCE, 4.6 here, and the current Fed funds rate is 475 to 500, expected to go up another 25 basis points on Wednesday. And a classic measure of like what's required to kill inflation is just get the Fed funds rate above the core PCE rate, and that's kind of what's required. And obviously we're there as of right now, set to go one step further on the Wednesday meeting. Another thing that I just want to remind you of is that everybody seemed to lose track of what was going on with the balance sheet when there was this big injection of liquidity from, saving the banking crisis and all that nonsense. Notice that it's continuing to taper off here, but the conclusion I want you to think about logically is a lot of people made the argument that the only reason that the market rallied in here was because of the injection of liquidity. Then why is it, as this continues to taper off, all of this was not undone? Now, I get it. We haven't completely reversed all of that liquidity just yet, but you would have thought that the market would not have continued in the upward direction if the only reason, again, keyword emphasis on only reason, was just because there was an injection of liquidity, right? If that were the case, you would have expected a pullback here off the top of the range. It simply hasn't been the case, so this does strike me as a slightly more bullish data point, thinking that markets have sort of recovered here to some degree. Let's take a look at earnings. So here's the calendar for the week, and I'm just going to show some honorable mentions. Of course, you can watch anything that your heart desires here, but these three are the top watches for me, especially Apple on Thursday after the close, heaviest weighted constituent of the S&Ps as well as the QQQ. If we move on over to the FactSet earnings insight, we'll continue to see that companies from the S&P are reporting. So 53% results are out so far. 79% of the 53% have reported a positive EPS surprise. 74% of the 53% have reported a positive revenue surprise. That is noteworthy here. If we take a look at page 6, I want to show you that for calendar year 2023, the bottom-up EPS estimates are actually on the rise. If everyone here is thinking, hey, we're going to go into a recession, wouldn't you think that EPS is set to take a beating if companies' earnings are going to start to take a hit? Certainly not the case based on the data that is coming in hand. If we take a look at page 8, we will note here that the percentage of companies who are beating estimates is 79%, and that's above the 5-year average. It's above the 1-year average, it's above the 5-year average, and it's above the 10-year average. So we're doing far better than the expectations. And just remember that the stage was set for Q1 to be an absolutely horrific quarter, and right now we're coming out with lots of positive surprises. If we go all the way on down to page 30, this go ahead and reinforces the idea of the uptick we just saw on page 6, but look at the EPS bottom up for calendar year 2024. That's the dotted line on top, up there at 246. And again, this is not a call to say that, let's take 246 and multiply it by an 18.5 average PE ratio. The S&P must be trading at what would that be, 45, 50-ish by the time 2024 comes around. It's not about the precision of the number. It's about the directional vector here. The fact that this is perking up, it's the first time we've seen it perk up in this entire chart. Maybe there's an uptick here. Maybe there's a small uptick here. this is certainly starting to become more meaningful. And once again, this does not jive well with the recession narrative. If we're going into a recession, this number should be moving lower. And I suppose, yeah, maybe 2024 is far enough on the horizon where we've seen a recovery by then, but you can see the same thing in the 2023 numbers, which is what I showed you on slide 6. Some risk appetite charts here. TLT kicks us off. Remember that this was concerning as of the Wednesday breakdown. It wasn't quite breaking the resistance trend line from here, and notice that we've backed off significantly into the end of the week. So flight to safety still not on the table as of right now. The TLT has not yet perked up over this 110, and also we're not seeing the outperformance on a relative basis to the equities market down below. If we take a look at something like the HYG, this continues to remain in the cautious camp. Remember that this balance area here is basically the same as this balance area in here. Equities are pushing for that new higher high. The HYG is still in a negative divergence, not showing a new higher high, hardly even getting close to these areas on the Thursday and Friday rallies. This would be a red flag, and the HYG has not led us astray throughout the entirety of this move right here. So I'm going to stand by the HYG with this one and say that you should probably be skeptical about just straight up continuation in the S&Ps as we open up early this week, unless, of course, this is being confirmed with a big breakout in the HYG. If it just remains sideways, I'd be very, very cautious in new higher highs out of the S&P. If we look at something like the digital gold just to see what's going on in the crypto landscape, what we'll notice is that we've undone a lot of the breakdown from the large red-bodied bar. We never actually took out these lows. If we move on down to something like a daily time frame chart, what you'll note is that any sort of head and shoulders that was trying to form in here, ideally it would have been after this indecisive doji, not the case on the Thursday and Friday follow through in the upward direction. I'm not saying it can't happen, but it certainly looks less likely. This does strike me as a better signal for a long risk appetite driven type market. Breadth is back to being really neutral. One note here in new highs versus lows. If we take a look at the daily time frame chart, that was a weekly we were just looking at. Intra week, we certainly dipped underneath that zero line, and things were not looking great on that Tuesday, Wednesday breakdown. The fact that we've recaptured into the close of business does strike me as a slightly more positive force. It's not bullish, it's not we're going to the moon here, but it certainly isn't as concerning as it was on the Wednesday close. Similar things can be said about the SPX A200R. This was suggesting some sort of move underneath in here. Now it's much more neutral, just kind of hanging out around the 50% mark. And we can also see on a daily time frame SPX A50R, this is daily time frame here, there's that slip and strong recapture into the close of the week back above the 50% mark. That does strike me as a constructive look, but again, the key is we've got to stay above that. We can't really afford to be whipsawing back and forth around in here. Like, make a decisive move if you're going to start to give us more confidence in an upswing here in the equities market. So far, the recapture, it's a step in the right direction, but we're not out of the woods by any stretch of the imagination. And this is especially true if we look at something like the RSP equal weight S&P 500. Sure, we did find support off of that key zone, the top of this range here at the 141 area. So not all is lost, but we're certainly not anywhere close to the equal highs. That would be the equivalent of this in your RSP. So big divergence from that perspective. Once again, this kind of falls more into the alignment of the HYG, telling us to be skeptical about breakouts in the upward direction here early week in the S&P. And the same thing, again, once again, reinforcing these ideas are going to be the transports versus industrials here. Transports not even close to getting back up towards the breakout point, whereas industrials are getting, they're looking like they're ready to go here. And this would say, hey, not so fast, kind of a red flag at this point in time. Cool off, let this thing sort of recover, let this go sideways, balance a bit more. Maybe then when these things sink back up, we get a bull flag breakout and a balance range breakout over these highs. But right now, lay off the pedal to the metal. VIX volatility absolutely floored, coming down towards that 15 handle, reads we haven't seen in over a year and a half. And under normal circumstances, this would start to suggest that, hey, this is just a higher low on the daily time frame chart. Markets are content with that. But as we know, there's kind of some funky business going on with the VIX. So let's take a look at some other evidence here. The VVIX, volatility of volatility, kind of confirming it. Even if you don't want to believe in the VIX itself, VVIX coming back down here into this balance range, certainly more indicative of comfort instead of being on edge, closer to 103. And let's look at our newest data set here, which is the VIX futures as always. But here's the VIX one day. We just don't have enough information at this point to see how this is going to materialize. But so far, these are the updated futures contracts moving deeper into a contango, more risk in the future instead of the present day, even in the 9 versus 30-day VIX. So if you're concerned about, options and zero DTEs messing things up, this is as close as we can get right now. This is certainly rolling over off of the zero line. That, again, is indicative of contango, more risk in the future. It's exactly what money managers want to see to allocate capital towards these markets. Here's our QQQ NASDAQ 100 on a monthly time frame chart. In terms of candle structure, we're dealing with a small green-bodied hammer. Of course, buyers stepping up in the lower wick to the open, through the open for a solid close up towards these highs. On the monthly time frame, I would certainly start to think of this as a 3-bar play, taking out the 2 equal highs, and we're looking for continuation in the upward direction. Structurally, I would also point you to the fact that, hey, this is all happening above previous support, which was then acting as resistance in here, resistance in this red upper wick. We're now above that, and this lower wick would suggest that we're using it as support. On the monthly time frame chart, there's quite a ways to run up towards this 365, 370-ish target on the upside. If we take out some basic Fibonacci's from our C19 low all the way on up towards this high, we are back above the 38.2. This one did come in for a deeper test of the 61.8, but notice that we never closed a monthly bar underneath that area, and we've also been respecting our monthly 50 SMA here. Let's take a look at our weekly time frame chart now and see what's going on from this perspective. Once again, a number of ways to consider this. You could think of this as a double bottom, and we're staying above this neckline. You could call this a weekly bull flag, and we have a weekly bullish engulfing hammer here closing over the highs. We should look for continuation. You could even start to say, hey, we've got a inverted head and shoulders that looks like this. The neckline would be through those 2 shoulder marks, 1 and 2. We're above that. We're consolidating above. That does strike me as bullish. Of course, the head is that double bottom we were just referring to. Just so many nuances here from a structural perspective. This is also going on where the previous pivot top is acting as support on the breakdown underneath the balance range. So again, sweep the lows and then move through the highs. What's going on? Are the sellers really that strong? Objectively speaking, again, this is not an us versus them. This is just saying, hey, the buyers actually outperformed here with this close over the top of this overall range. If we go ahead and throw on our studies with the anchored view apps for our QQQ, just note that here's the all-time high anchored view app. We're above that and pushing through the breakout of that bull flag we were just referring to. If we take a look at the volume profile on the QQQ weekly, this is extremely interesting, right? If you want to get very nuanced, we have technically closed above this high volume node. I wouldn't say it's fully resolved yet, obviously, but remember that there's not a whole lot of volume resistance as we move above some of these levels in here. The door is certainly open towards these pivot highs around 337. Again, not making the call for this in the coming weeks worth of trade, but over time, 340, 337. Again, you can see the pivot from in here. That's certainly within striking distance if we look at this weekly time frame chart objectively. Let's move on down to something like a daily time frame chart, and we will of course evaluate our expected move, all that good stuff, and see what's going on, and of course move through the internals, all the supporting evidence, and we'll keep this train moving right along. So here's the balance range, expected move, of course suggesting a higher high or higher low inside of the original balance, nowhere close to the breakdown from the Wednesday session. All the same psychology basically applies as to what we discussed in the S&P itself. So the difference here, of course, is that we're opening above the top of the balance range. So in a picture perfect world, the bulls actually produce a higher low above 320.50. That's your break and retest, confirming what was once resistance as newfound support. That's the picture perfect rainbows and butterflies situation for the Qs to continue into the target overhead at 326.25. Then the upper edge of the weekly expected move, 330.11 is the number there. On a deeper pullback, it's not the end of the world if we give up 320.50. It wouldn't be ideal, don't get me wrong. That would constitute a look above and fail, but I wouldn't be shorting into this area here. Just remember how strong it was from this, and then also these rejection points right in here as well. If we move on down to something like an hourly time frame chart here, let's go ahead and show you this. I just want to illustrate a similar concept as to what we discussed in the SPY. Notice that 319 could also be a pivot here. That's where we pulled back early morning on the Friday session, found support, and rallied into the close. So treat 319 down to 318 as a bit of a zone. Another reason I would suggest these areas is if we take out the fibs again from the rally lows to the highs. You don't want to go from the breakdown lows over here. The 61.8 line in the sand is the top of that range at 318. Remember that it was providing strong resistance in this area of the chart back here. If we do move underneath 318, I would just look for chop, right? Certainly might be constructive for the full look above and fail if we get the lower high underneath, but as we know, we have trust issues with this market. I'm just not convinced anything too impressive happens under 318. Like, prove it to me on the opposite side this time around. Again, just like we did with the SPY, ideally, there was a lower high here. Sure, it happened on the Wednesday session, but even then, we closed here, right? Another lower high, okay, maybe. Another lower high here, no. There was just no lower high that was even attempted on the hourly time frame chart. Just very difficult to pretty much say that, you know, the bears had something going on. Thursday and Friday really wiped out that as a situation. If we look at the internals for the QQQ, the NASDAQ specifically, again, all similar comments, basically neutral here. One thing I will point out is that on the breakout and reattempt here, we talked about how it's much more difficult to buy into a new budding uptrend. It's not even close on the QQQ and the NASDAQ markets themselves. This should have been much stronger if it was going to be comparable to an opposite and equal move to the Tuesday session. So be a little bit cautious about that QQQ. This type of evidence that we're seeing here on the internal screen would actually suggest that, once again, I would not be looking for just straight up continuation out of the Qs. I think it's much more reasonable that a pullback could unfold here and we could look for that higher low to start to look for more of a constructive uptrend on the daily time frame. If we look at something like the market profile, I would just point out, let's keep it simple once again, that value area and point of control did migrate higher. Value area was actually lower in the session on the Friday session specifically as compared to the S&Ps. So a little bit of slowdown here, certainly reasonable. That pullback, certainly reasonable, more so in the Qs as opposed to the S&Ps. IWM monthly time frame chart dealing with a small-bodied red hammer here happening at the bottom end of an overall monthly balance range. This certainly looks more like a monthly bear flag than anything else that we've seen on monthly time frames. That's not all that great of an indication, remembering that IWM acts as a proxy for risk on and risk off. Now again, the hammer at the lower edge of this range does strike me as possibly being an opportunity for a long over the high to retarget the top, but as we know on the weekly time frame chart, it's not so clear cut. Let's take a look at our Fibonacci's here. This is fairly telling, the fact that this one really hasn't rebounded firmly off of any Fibonacci retracement. We know that the Qs moved firmly away from the 61.8, the SPY moved firmly away from the 50%. Not the case in the IWM, really struggling to get any traction here at the 50% retracement or even 38.2 retracement, acting as the top of this overall range. If we move on down to something like the weekly time frame chart, once again we have a hammer. This is looking like bear flag. I wouldn't short it yet until we actually break down through these lows, especially with the hammer structure here. There was an attempt to move lower, right? But where did we close? Firmly inside of this, which we know to be the daily balance area. This is the monthly balance area that we were just looking at. This really doesn't have very strong indications for our market kind of across the board here. One thing I do want to show you actually is our volume profile on the weekly time frame chart for the IWM. Notice that we're sitting on a strong area of volume support, and there's a huge low volume void overhead until we rotate back up towards this area in here. Not calling for that in the coming weeks worth of trade, of course, but just pointing out the structure surrounding us. I would more importantly say that if we were to move over the top of the weekly balance, we'll see that on the daily time frame chart in just a second. If we move above that, that could start the break towards this next area. Not suggesting this yet, but certainly something a bit more constructive towards these like 185s, give or take, the bottom perhaps before the drawdown of the banking crisis from in here. Let's also show you very quickly our anchored VWAPs on the IWM. So coming from the all-time high and the low from October, still underneath the low from October anchored VWAP. Clearly a lot of relative weakness in small caps, once again acting as a proxy for risk on versus risk off. Doesn't really sit all that well with a huge recovery effort in the broad markets as a whole. Jumping on down to the daily time frame chart, expected move is not nearly as bullish as all the other charts we've seen so far, expecting an equal high in this balance range from this perspective and an equal low as well. So pretty neutral based on that. I will say there's a strong opportunity here for a break, retest, and lower high off of 175.75. So if the bears are going to run away with it early on in the week, make sure it's a lower high here. I then look for a pullback out of the SPY and the QQQs, and then I would reevaluate when the IWM gets to the equal low here. Is that enough of a pullback to like 410.35 in the SPY? If you see support here, if you see support in the SPY at 410.35, that's kind of how I see the intermarket dynamics playing out this week as all these things kind of come together to support a narrative. If the IWM does start to poke into this overhead box, I would just treat it as choppy. We know that not a whole lot of anything was happening in here. This is obviously constructive, as we just saw on the weekly time frame chart over 180. We can start to look for that 185. It's a long one today with these monthly time frame charts. Do me a favor, hit the thumbs up button, subscribe, all that good stuff. If you've made it to this point in the video, I'm sure you're enjoying the analysis. With that said, let's dive right into Apple. What's going on here? Earnings on the Thursday session after the close, as we discussed just a moment ago. We did see follow through on the Friday session. So do you want to be buying higher highs? Probably not. I would also start to not trade this thing as we get closer to earnings around that Wednesday time frame. Implied volatility is going to start going through the roof on the options chain. Before then, though, I would be looking for pullbacks that support support off of 168 for then an equal high, and then something that does this perhaps, again, ahead of Wednesday. If we do break down underneath 168, it's all about 165.50. We know that this area has been extremely stubborn in Apple, so I really wouldn't want to see any lower lows underneath that area if we're going to preserve this most recent uptrend in here. Next up is going to be Netflix, really stuck in a balance range, nothing impressive happening yet. So until we can break 332.50 in the upward direction, I would be neutral on this. If you're a scalper, I would say that there's an opportunity at least to look for continued higher lows over 327, and then we're going to be constructive on that break in here. If we rotate underneath, you guys know the deal. It's kind of just chopping around in that daily balance that we were just looking at. Here's Tesla. This is kind of recovering off of the earnings gap down, but once again, I still don't think it's an easy long until we're back. And even then, it's not going to be easy, but the more constructive and easier to spot long would be into the overhead gap over 167.20. Strong recovery effort on the Thursday, Friday session, especially on the hourly chart. You can see how we supported off of the neckline of what could be construed as a double bottom here on the Friday morning session. That was great, but again, how do you play this long at this point? It's got to be a patience play over that 167.20 to start to close the gap overhead. Higher lows are ideally constructive over 161. You could look for pullback buys there. Anything underneath, kind of just off in no man's land. I wouldn't trust it underneath 161 on the long side. Next up, we're going to take a look at Google. What's going on with Google? Here's the daily time frame chart coming into these equal highs. I think this play is fairly straightforward. Inside bar on the Friday session, it's a long over the highs, 108.75, or short underneath these lows at 103.75. Anything that just chops around in here, don't really want to be involved. I will say that the close over 106.50 would lead me to believe that, hey, maybe there's a slight bullish edge, but again, it's still a patience play until 108.75 is broken in the upward direction. Next up is Metaverse. What's going on with Zuckerberg's Fantasyland? Two bar just balance unfolding here. This is exactly what we expected with the too many sides of the trade miscommunicating, right? You have longs who want to buy this on upgrades. You have longs taking profits. You have shorts who are squeezing out. You have new money shorts positioning. You have a whole ton of everything going on here. I wouldn't expect anything major out of Meta until we can get out of this range. So over 240.75 or under 236.80. Moving right along to NVIDIA. Earnings often no man's land. It always feels like NVIDIA is always late to the party. Anyways, here's the balance range. Once again, fairly straightforward. Over 280, target 287.75. Higher lows are constructive over 274.25. Anything underneath that area, just target the bottom end of the range. We're range bound, and that's that. I would only look for stronger shorts on a breakdown of 262 if we get the lower high underneath. Remember that we have trust issues with this market. Next up is Softy. What's going on here? Certainly some follow through after the earnings gap up, but coming into resistance at 310. Once again, do you want to be chasing this on new higher highs? Probably not. In a picture perfect world, it builds out a flag up here, and then over time it starts to break that 310 for our next target at 315.25. Anything underneath 304.75, you're only shorting the lower high if we get it. Remember, you also don't want to be just blatantly shorting in the face of a strong move in the upward direction. So difficult to pick off a new money long, but also just no indication of a short yet, not even an inverted hammer up here at these highs. So be patient, wait for the lower high underneath if you are trying to get involved on the downside. Last but not least, the mini beast. We've got Amazon before these two trade ideas. This is a messy chart. This is definitely a messy chart. I will say it is trending clearly in the upward direction with lows, higher lows, higher lows, higher lows, all that good stuff, higher highs to complement it as well. But as we come into this area, just extremely choppy. In a picture perfect world, we build out some kind of hammer early on in the week, take out the high and rotate back up for something that looks like that. That's if it wants to give us a textbook type rotation. If it breaks down, once again, because we're sitting in an uptrend here, probably wouldn't look to get aggressive on the short side unless it's a clear lower high underneath this zone, 105 and 104, then retarget this area from in here. That will be a flush point at 101.25. One last reminder for a thumbs up, subscribe, all that good stuff. If you've made it to this point in the video, I'm sure you're already subscribed anyways. Nobody who's not subscribed watches this far. Anyways, CSCO is up first for a trade idea. Look at the hammer from the Thursday session, undercutting the previous lows, closing back in the range, and then follow through on the Friday session, building out a double bottom over this neckline at 47.38, 47.40 roughly. We're going to target 48 to close this overhead gap, and then we have thin structure through the breakdown bar up towards that high, the opening print basically at 49.25, give or take. That's CSCO up first. Next up, we're going to take a look at DIS. Last but not least in this, mega long video here. Let me know if you made it all the way to the end, and you can do so by saying something about Walt Disney in the comments section. Anyhow, inverted head and shoulders, really sloppy, but it is there. Once again, I would not advocate for a new long as we're coming into resistance after a major break in the upward direction here. I would wait for a pullback, and then a reattempt gets us over that neckline at 102.50. You can look left through the thin structure. Our next major target is this breakdown candle high at 107.68. May not make it there all the way before earnings, but this would just be a long watch, presumably so, after a higher low and a reattempt at 102.50. That's all I've got for you in today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know in the comments section or by giving the video a simple thumbs up. I hope to see you all live at 8:15 on the Monday morning session. And with that said, have a green trading week.